Welcome, ladies and gentlemen, to Commodity TV in a new edition of our online interview series. We want to get an update of gold royalty, and David Garofalo, the CEO, is here with us. Welcome, David, and hi.
Good morning, good afternoon, as the case may be.
Absolutely. It's good afternoon. And before we start, I have to say that because of the BCSC, this video is on behalf of and paid for Gold Royalty, of course. So let's get started. David, I must say, as always, impressive growth path. We spoke about it several times the last 2-3 years. But I think your half-year numbers you reported, they are not only fantastic, but it looks to me like you guys start to make profit-free cash flow. So what's the situation?
No, absolutely. This is our inflection year. It's been long advertised that this would be the year that we start to generate positive free cash flow. And that certainly has been the case in the first half of the year, both positive operating and positive free cash flow, record revenues from some of the biggest operating assets in North America, and complemented now by the Varus copper stream, which is also ramped up. So we have a number of projects that really contributed to these record numbers, but we're poised to actually see our revenue grow a further 360% over the next 5 years. And because our costs are absolutely flat and stable, that means every incremental dollar of revenue will fall right to the bottom line. So we have an enviable free cash flow growth profile through the next 5 years, to the point where we're actually going to be debt-free by the end of next year, in a position to talk about returning capital to shareholders in some form.
Oh, okay. I love to hear that because you're a shareholder also. So debt-free, that sounds on the one hand fantastic, but do you have also enough firepower to do some new deals maybe? Or to help existing deals?
We do. We have a $75 million line of credit with Bank of Montreal and National Bank Financial. Only a third of that has been drawn, so just a little over $25 million. As I said, that'll be largely repaid by the end of next year from free cash flow. So that credit card has an unutilized limit of $75 million. And that's the objective, is to use that available credit, to use the cash that we're going to be building up on a balance sheet to give us the firepower to continue to accumulate creative assets, ones that fit our core competencies or our core strategic vision, to continue to grow our precious metal royalty portfolio over time.
Okay, super. So in your existing cash flowing royalties and streams, do you still need to invest something more there, or is that all set and done and you just can say, okay, let's harvest?
No, that's an excellent point. So we have about 250 royalties. We have 7 that are cash flowing, 14 in various stages of construction. All of those royalties are completely bought and paid for. They have no capital calls, no installment commitments whatsoever. So we're very much in a harvest mode. So we've invested over $500 million in building out this portfolio over the last 5 years since our IPO in March of 2021. And now we're in a position to start to harvest that free cash flow. And that's been evidenced by the results we've already achieved in the first half of this year, with positive free cash flow for the first time in our history.
Okay, super. What I found really interesting is if I look at your growth pipeline, and you name it in the presentation, high quality growth pipeline, I see it the same way. Fantastic projects, even if you go from exploration to advanced exploration, but also development is very important, because development means to me maybe the next 2, 3, 4 years, then also cash flowing, meaning in production. I saw there very often the US flag. So does that mean you do more a little bit of a switch into the US here now? First thing, and second thing, does that help also with the tariffs?
Well, look, over 80% of our portfolio is in Nevada, Quebec, and Ontario. I would say about 40% is in Nevada itself. It's where we have boots on the ground. It's where we're generating royalties organically. It's primarily because it's a great geological district. It's a one of the most prolific gold districts in the world, and so you want to have a presence in that area. But we do have boots in the ground. Jerry Boffman, who runs our U.S. business, stakes exploration claims around existing mines and deposits, farms the properties out, and takes royalties back in returns. So in Nevada, we're generating 2 to 3 new royalties per quarter. And we're doing that for free. In fact, it's not even for free. We're getting paid to generate those royalties, because not only are we getting those royalties for free when we farm the properties out, but quite often we're getting option revenue when we farm the exploration properties out. We get $3 to $4 million of option revenue per year, which helps significantly defray our G&A costs at the corporate level.
Absolutely. Great. Also, the question is not only with the tariffs, but I think you have also accelerated permitting. You have maybe easier permitting. Do you feel that already for those projects in the development now that things go smoother or even, which is important, faster?
Yeah, look, I think Orla Mining's had some success on their property that we have a royalty on South Railroad. They just got their next stage of permitting done. I-80 is working Granite Creek forward through the permitting phase and actually ramping up production as we speak. So we have noticed a change in tone in the U.S., a more expedited permitting process. Obviously, that plays well for the significant number, dozens and dozens of royalties we have within Nevada. That means those projects are going to be de-risked and advanced to various stages of production in a much more accelerated fashion than they have been historically.
Okay. Um, if you would say, because let's put it that way, your stock price this year went up 100% approximately already, which is
Actually,
fantastic.
200%.
Sorry, 200 already. Okay, good. I was too conservative. Sorry. I just had a short look onto the point and figure chart. And I must say, yeah, this is already a fantastic move. I mean, we always anticipated that. I think also in our chart productions we did by ourselves, we said always $3.50 is a target for us, which we reached now. Yeah, the next ones are easily $5 and $6 and could go higher, of course. Yeah, so we see how that goes. But would you say, in relation to your peers, are you now fair valued? Would you say, yeah, given your growth, there's much more to come?
Well, look, I think our growth profile is actually absolutely unparalleled across the royalty universe. And I'm not just talking about our more immediate smaller cap peers. I'm looking across the entire royalty universe. And there's a dearth of growth, particularly in the high end, the high
Yeah, yeah.
market cap end of the range within the royalty universe. So what we're offering is growth in politically stable jurisdictions, and that growth is still quite significantly discounted. And we think unfairly so because we have royalties on three of the five biggest producing gold mines in North America: Canadian Malartic, Côté, and the underground extension of Goldstrike, Ren,
Mhm.
which are within the hands and the portfolios of well-capitalized operators with extremely deep technical teams. So I would consider that very low-risk growth. I think that growth has been significantly discounted unfairly, again, given the pedigree of the operating teams and the quality of those deposits. Those are not just short-term deposits, ones that are going to be running for 3 to 5 years. They have
Mhm.
20, 30, 40 years of reserve life ahead of them. So not only do you have well-capitalized operators, great jurisdictions, but you also have a mineral deposit that continues to grow through the brownfield exploration efforts of the well-capitalized partners that are advancing and optimizing those operations.
Okay, super. So, if we look at your upcoming catalysts, let's say below 1 year, which is really short term, there you have we look already at 6 projects. That is fantastic. But what also catches my interest here is, I mean, gold today is almost $3,600, which was one of our targets, right? And I remember in our one of our last interviews, you were saying, "Hey, $3,000 for sure, not a problem." Gold was at 2,000 something, yeah, and I was also bullish. So what I find really interesting is, what is the sensitivity on your revenue stream, I would call it, with the gold price? I mean, you must feel that positively, right?
Yeah, absolutely. So, I mean, just to give you a sense, by the end of the decade, we're approaching 30,000 ounces of gold equivalent production per annum. And that's sustainable over a long period of time, given the foundational element of that asset base that I talked about, some of those large scale mines within well capitalized operators. So, apply a $10 increase in the gold price. That's, every $10 increase gives us 300,000 of incremental revenue. Every $100 gives us $3 million of incremental revenue. Our G&A costs to run our entire business is somewhere between $7 to $8 million. So on 30,000 ounces of gold equivalent production by the end of the decade, you're well over $100 million of revenue at current gold prices. Think about the free cash flow generation that entails. Is that 80, $90 million, $100 million of free cash flow? What kind of multiple do you ascribe to that? 20 times? I mean, just to pick a number out of the air, that implies that our stock price will be 3 to 4 times where it is today. just
Mhm.
on the asset base that we currently own that is completely bought and paid for. We have no capital commitments. So again, the costs of running your business are de minimis. It's a very scalable business, and that means every incremental dollar of revenue of gold price increases goes right to the bottom line for our shareholders.
Okay, super. Um, that yeah g- brings the question up to me. You said it already. You want to give money back to shareholders. Can you be a little bit more precise on the plans already, meaning dividends, share buybacks, when it might start, or is it just a longer term planning?
Well, look, we expect to be basically net debt free by the end of next year. So effectively, our revolver will be paid back out of free cash flow. Our convertible debentures, which only mature in 2028, are actually callable by us at the end of next year, and they're very much in the money. So that means that they're going to be converted into stock. So effectively, we will have no debt at the end of next year. So all that free cash flow can then be deployed in two things. One is to continue to grow our business, but also to start to return capital to shareholders in various forms. And that can be a dividend, it could be share buybacks, and that'll be largely driven by where our share price is. If it still continues to be depressed on a valuation perspective, then it might make sense for us to buy back some of that stock or find some
Mhm.
sort of balance between dividends and share buybacks. I can tell you why we haven't had definitive discussions or recommendations to our board. I know our board is keen and eager to have that discussion once we get to the other side of net debt free.
Okay, super. If we look at your portfolio, those are, yeah, now really large mines which are cash flowing. There are some more large mines coming into the play. If you would look over that portfolio by now, let's say within the next 2, 3 years, um, what is the approximately average mine life of that? Meaning, can you do that business? I wouldn't say forever, but can you do it easily for the next 20 years?
Well, and maybe a way to quantify it is how many ounces do we have underlying that portfolio? And when we started back in 2021, we only had 18 royalties in the portfolio, collectively about 30 million ounces of gold equivalent exposure. That's grown to well over 120 million ounces over the last 5 years. So that gives you a sense of how much ounce exposure, how much leverage you have to the gold price within the resources in the ground within our portfolio. So it is significant. But the large scale nature of some of these significant deposits and long life really underpin the portfolio and provide annuity for our shareholders for decades to come. So you look at Canadian Malartic, look at Cote, look at Ren, which is underground extension of Gold Strike. These are not only deposits that have been operational for a long time, but ones that have significant brownfield exploration potential and continue to be extended continually over time. And our operating partners in aggregate invest about $200 million per annum in brownfield exploration. So that means those ounces are not static, they're dynamic. They will continue to grow as our operating partners continue to invest in the brownfield exploration, which I hasten to add, we contribute nothing to. We get that exploration optionality absolutely for free due to the nature of our royalty model.
Okay, super. If we look at the company as a whole, together, I mean, now I think you at least have done the valuation you really minimum deserve. Yeah, I think there's a lot of yeah, optionality, opportunity here also for the future. Who are your largest shareholders? Are you well protected, let's say, against the takeover in that sense? Because this is a cash machine, and I could imagine with a gold price at four, five, $6,000, it looks, yeah, let's take it that way. It looks really bright.
Well, we do still have a number of strategic shareholders, namely Gold Mining, our former parent company. They've never sold a share. They own over 20 million shares, or about 12.9% of the company. Barrick continues to own about 6% of the company by virtue of selling us a portfolio of royalties a few years ago. They've been a very loyal shareholder. And then when you look at insiders and add that to those strategic shareholders, about 30% of our shareholder base is owned by strategics and insiders. So that continues to be the case. There's no absolute protection in this world. I mean, the best protection is a good share price, and we want to see our share price start to appreciate to reflect the intrinsic
Yeah.
value of the quality of our asset base over time. And I think we're starting to get some of that recognition in the marketplace, but we're a long way from where I think fair value is. And
Mhm.
you've hit on the theme of consolidation. It is happening. It has happened. We've seen Sandstorm taken over by Royal Gold. We've seen Origin taken over by Triple Flag, and there will be
Mhm.
more consolidation because inevitably, what will happen is that $1 to $10 billion market cap range will be basically void. You'll have the mega cap companies, and you'll have the small cap, and there'll be a rush to consolidate smaller cap players to fill that void because that's the Goldilocks zone. That's where you're big enough to be held by institutional investors, but still small enough to grow. And what we can offer relative to our large cap peers, the mega caps, is growth. What we
Mhm.
need to achieve is scale, and we can see that through consolidation. Consolidation is happening, will happen among the small cap universe. And if anything, I think as that starts to gather momentum, more and more of these small cap names will start to get takeout premiums.
Mhm. Okay, super. Um, do you see any risks on the horizon for that business model?
That's the beauty of this model is the risks have largely been mitigated. We don't have inflation risk. It's top line exposure in virtually all of our royalties. So
Mhm.
every dollar increase in the gold price does not result in any increase in our cost of sales because virtually all of our portfolio is royalty. So it's all top line. So you're mitigating inflation risk. You're getting optimal exposure to the gold price as a result. So leverage of the gold price. You're getting leverage to expiration. So, if anything, as the gold price goes up, there'll be more exploration conducted on the properties that we have royalties on by our operating partners. We'll get the
Mhm.
leverage of that exploration success effectively for free. Our cost
Mhm.
structure has been stable. In fact, it's actually come down because we've realized significant synergies from the companies we absorbed back in 2021. So we brought G&A costs down. And so, if
Mhm.
anything, we're de-risking and we have substantially de-risked what little risk we have within the portfolio, and we're seeing that growth start to crystallize. And that's been evidenced by the performance we've already achieved in the first half of this year, which will only improve over time as these assets are not only achieving nameplate capacity, but undertaking significant expansion opportunities as well. Again, off the balance sheet of our operating partners, as these assets get expanded, both geologically, they'll be looking at ways to expand their operations as well. And that brownfield expansion will be absolutely and completely financed by our operating partners.
Mhm. Okay, super. As we are always talking about the gold price, let's put it that way, our targets are reached, at least mine at 3,600. So I have the next one at 3,700 and 3,900, and then already 4,200. I could imagine that this happens by Christmas already. I know I'm a little bit maybe too optimistic, but to me it looks like. So my question is, what is your take? We both know the that situation in the world has gone worse since we talked the last time. It looks really not good. So what is your take?
Yeah, it has worsened dramatically, and I look at the spending bill that was passed in the U.S., which
Mm,
from a fiscal standpoint was egregious. I mean, if I were a U.S. taxpayer, I'd be very, very concerned. And it's exasperated the debt profile in the U.S. dramatically. And that means that there's only one solution for the U.S., which is to print more money. And that's really been a one-way trade for 50 years since we abandoned the gold standard in the early 1970s. Is we've seen the gold price go up in only one direction, and the U.S. dollar go in another direction in terms of purchasing power. The
mhm,
relationship is so linear, it's simplistic. We've seen the gold price go up 100-fold, and we've seen the U.S. dollar depreciate by 99%. I mean, it's a very linear relationship. Certainly, there's volatility in the interim, but the relationship
mhm,
between purchasing power and the gold price is dramatic.
mhm.
Gold is like the canary in the coal mine. It's telling you that there's a problem. It's telling you that the fiat currencies are being significantly and relentlessly debased, and the gold is an agnostic barometer of what's happening in that regard.
Absolutely. Super. Hey, David, thank you very much for the update. It looks really good. I think you guys did everything right, despite maybe the IPO price was a little bit too high. But now you're reapproaching that. This is fantastic, and there was money to be made here this year and also for the next years. And I like your return to the shareholders with buybacks and also dividends. That's a great plan always. And yeah, wish you well. We talk soon. Thank you very much. All the best.
Thank you.
Thank you. Yeah, ladies and gentlemen, that was David Garofalo, the CEO of Gold Royalty. And you heard it, the stock appreciated already 200% this year. But to be honest, this is just the beginning. The company has the highest growth path until 2029, over 300, I think it was 376% in the presentation. They are growing here their business. And of course, they benefit from a higher gold price as well from copper and silver, which is fantastic. And they want to let the shareholders participate into that after repaying their debt. So really have a look on Gold Royalty. Thanks for watching us, and bye-bye from Switzerland.